Quick confession, I get so excited talking about reverse mortgages that I forgot to introduce us during the actual recording. So I'm popping in after the fact. I'm Christy Osborne, and this is my business partner and assistant, Sabra Bowden. I teach anywhere from 1 hour to 8 hour courses on this topic that we talk about in this podcast. So we're only scratching the surface today. But if this line of credit conversation gets your wheels turning, I'd love to talk with you one on one. What if you could draw down from your home's equity and that could grow like an investment account and be there whenever you need it? In this episode, Sabra and I are going to break down the hidden power of the reverse mortgage line of credit and why it's changing the way retirees think about cash flow, security, and freedom. Welcome to Legacy Years, the podcast. I am so excited to have Sabra on here. She gets to sit and listen to me film these all the time. Sabra, we are talking about something that I feel like a lot of our clients, when we talk to them, even our financial advisors, when we talk to them, really don't fully understand and grasp the power of this feature of the home equity conversion mortgage. You agree with that?
Absolutely. I feel like a lot of our clients feel like it's a traditional HELOC.
Yeah, I think I see that a lot too. So when you think about a traditional HELOC or home equity line of credit, anyone can get that for starters. They also can freeze that at any time. They can call the note and stop the loan from being able to be drawn against, which is what I think is the biggest difference between this product and the home equity conversion mortgage. Because once a client puts it in place, the bank is never going to come back to the client and say, hey, guess what, Mr. or Mrs. Homeowner, we feel like property values have gone down in your area. We just don't want to, have that line of credit open for you anymore. They'll never say that. And in fact, it places a put against the value of the home from the time that they take that loan out. So even if property values do go down, that line of credit is still doing what it was intended to do when they first opened the loan.
And I feel like one of the things you and I are always going over are the different benefits of this product. So why do you think it is so underused by clients and then also just by financial planners underusing it in when they're planning for their clients' retirement?
Yeah, I think maybe the biggest reason that I see is people don't really understand how it works. They think, "Oh, I don't need it. So I'm not going to put that in place right now." And I think that people look at it from a last resort position or a desperate position, whereas it's a incredible tool to make that retirement money last longer. They just don't understand it. I think that's the biggest thing. And I feel like the more that we can educate borrowers and the more that we can educate the financial world about how this product truly works, I think we'll see more people utilizing it in that overall retirement planning scheme of things.
So we talked about just a second ago how that HECM line of credit is different than a traditional HELOC. Talk about how it grows over time and why that matters.
Yeah. So I think the easiest way to help someone understand how it works is to kind of talk about client scenarios. I find that a lot of times when I say, well, this is how client X, Y, or Z used it, well, then it becomes like a light bulb that goes off for people. So I have a client who put a home equity conversion mortgage in place, and he was still working, and he was not planning on retiring for a number of years. He was going to continue to make his monthly payment that he'd been making. And at the same time, he put this line of credit in place, paid off his existing lien, and he was building a nest egg towards when he would retire to use as a buffer asset. So, and these are not real numbers because I'm just going to make these numbers up, but he was, let's say, he was paying off a $50,000 loan. He was going to have around $125,000 in the line of credit after he paid off that loan. He was going to be making payments that were going to not only reduce the balance of the loan that he put in place, but also go into that line of credit. This is part of the flexibility of this product is every payment that you make also increases the amount that you can draw down from in the future. In addition to that, there's a growth rate associated with the amount that you can draw from that's equal to the mortgage on the loan. And so over time, the amount that you're going to be able to draw down would grow over time. And he was going to have somewhere in the tune of $125,000 plus the payments that he made that would be available to him at the time that he retired. Not to say that he was going to have to take those funds right at retirement and they were going to grow even more. So the power of that is crazy when you think about the ability to protect your other assets when the market is down and have funds that will increase the time that you'll have cash flow in retirement.
And I think when we hear that, that all sounds great. We only talk about the benefits of it, but it seems like when we talk to clients about it, they're like, well, yes, but I heard this. So what's one of the biggest myths that we continually hear from clients when we're telling them about this product or the line of credit and the benefits?
Yeah. I think probably there's two that come right to mind that are probably the two most common things that I hear. One is I'm signing my house over to the bank. I will no longer own my home. I can't sell my home if I want to. I can't refinance out of this loan if I want to. I can't pay this loan back if I want to. And so that's the biggest myth. That's probably the largest. And it's crazy to me how I still come across people who think that this is a mortgage, just like any other mortgage. They can pay it off if they want to. They can refinance out of it if they want to, or they can sell their home. And just like you'd get a payoff on a traditional loan, you're going to call and get a payoff on this loan. And you're going to say, hey, I'm selling my home. I want to pay it off. And the rest of the equity belongs to you. That's probably the largest one that I hear.
Yeah.
And I think you may disagree with me. I don't know. But I think the second one is, oh, I'm afraid I'm going to leave my children with a huge debt. And I think that's a big thing that people are concerned about, but these are non-recourse products. That's the ones that we work with. And that's just a fancy way of saying that the house is going to guarantee that note and not the person or their estate, regardless of the value of the home at the time that that loan is paid off. That house is going to satisfy it. So if the house is worth $100,000, I don't care if you owe $500,000, you will only pay it back what the house is worth, or 95% of the value. So that's a big sigh of relief for a lot of people because they come into a conversation with me thinking, oh, that's one of my concerns is that
Right.
I'm going to have a huge bill, or I'm going to leave my kids with a huge bill when this is over.
Right. And I know you said this a couple of minutes ago as well, like, oh, I don't need it yet. And a lot of people do view this product as a product of last resort. And I know we gave one example of how a client was using it. What are some other examples of how our clients have used that line of credit in retirement?
Yeah. So there are a number of ways that you can take your funds when you set up the home equity conversion mortgage. You can get funds every single month, like an annuity type product. And I have had a client who, you'll remember him. He was one of our favorite clients, and he came to me and he was running out of his retirement money. And he said, I'm going to be 91 in January. I didn't think I'd live that long. I didn't plan for that. And so he wanted to, figure out a way to replace the annuity that he was losing. And he came to us for one solution, not even realizing that the money that he was wanting to pull from his house actually could work in a different way. So we set him up with a line of credit that was just going to pay him out the exact amount that he was going to be missing from his annuity that was running out, and he was going to continue to live just like he'd been living. He was going to be 91 in January, and he was healthy as could be. And he was like, my uncle died at 92, my dad died at 91, and here I am going strong. He's probably one of my favorite stories because we had a great solution for him. Was just a blip on the radar, that annuity ending and the home equity picking up that cash flow for him every single month.
I do remember him. He was fun to work with.
Yeah.
And so you talked about the different ways that they can take it out. They can take it out monthly, they can take it out in a lump sum, they can never take it out and let it grow.
Combination of
Yeah,
those.
yeah. How do they have to pick, or what if they want to change their mind? If they at closing they decide to let it grow, but then they change their mind and want it monthly, can they do that?
Yeah, I think that's important to talk about because they're not stuck in however they start. So it's a nominal fee. I think it's $25. They can adjust the way that they're receiving those funds. I have a client who she wanted to start out with getting $500 a month, and then she wanted the rest to go into her line of credit for those larger things. She just needed a little bit of extra cash flow each month. But then for the larger things, she wanted to have some money, need a new car, the car breaks down, or I want to go on a trip, or, I need a new roof, whatever it might be. So she was going to have the benefit of both. She was going to get a little bit each month that would kind of supplement her income. She could stop pulling from her retirement accounts, let those sit there, continue to grow, do what they're doing, have a little bit of a savings account or a buffer asset for those large expenses. And that's a marriage of two ways to get your funds that's working for her. But if at some point that doesn't work for her, she's like, you know what? I don't need the 500 anymore. Maybe she's paid off some debt, or things have loosened up, or um, whatever the case may be, she can at any time stop that and just say, hey, I just want to leave it all in my line of credit, let it grow, and I'm going to pull from it as I need. She just call and change the way that that's being done, and they'll get it taken care of for them.
So I think something that's important for me and you is we don't want this product to be viewed only as a product of last resort where you can
Yeah.
financially plan for it, you can build it into your retirement. But there are some clients that didn't plan and it does become a product of last resort for them. It's something that is going to be a solution for something that they're really desperate for. What are some
Yeah.
examples of clients we've helped in that situation?
Yeah. You know who I'm going to talk about. My favorite situation for this is a gentleman that we had actually helped him buy his first home. So he got his traditional loan from Fairway about 15 years prior. And he came back to his loan officer, wasn't our team because we're the reverse team, but the loan officer who did his traditional loan. And he said, my mortgage is going up and I'm picking between my electricity bill and eating right now. I can't afford for my mortgage to go up. And it was going up because, as we all know, taxes have gone up and homeowners insurance has gone up. So, those things are really making people tighten those budgets. And we see it almost every day when we talk to our clients, which I'll plug right here. If you've not shopped your insurance in several years, you should definitely do that, because that's a big area where we see clients able to save money if they'll shop that. But that's neither here nor there for the client that I'm talking about. So we helped him. I think his payment was going from like 700 all the way up to like 1,000, and his income was like 1,200 a month. And so we were able to eliminate the principal and interest portion of that payment. He would be responsible for his taxes and insurance still, but it's going to put like $500 back in his budget every single month. When you're only on a budget of $1,200 a month, $500 is huge. And
Right.
so it made a big difference in his life being able to put that in place and eliminating that stress of, I'm going to lose my house because I can't make this payment, or I'm going to make this payment, I'm not going to eat this month. So that's just an example, an extreme example, but an example of how we can help with cash flow, because we take out that principal and interest payment if they're still making a mortgage, or we give them money every month out of their home equity to help with other things.
Uh, I know when we were talking about the line of credit, we talked how that interest rate goes with the market. So, how does the interest rate environment affect this product?
Yeah, we do. We actually run with what's called the constant maturity treasury. And so we're indexed against that. If you're in the HECM line of credit product, which is a variable rate mortgage, which most line of credits are. And so while it doesn't shift exactly with the market, we do run with the market. And so it's not like arbitrarily going to go up. It's not arbitrarily going to go down. The lender doesn't make that determination. The market does. So it does run with the market. So if rates go down, that rate will drift down. If rates go up, that rate will drift up.
And I know one of the things that we discussed earlier was them being afraid of leaving a big bill to their children.
Yeah.
And we talked about how there's protections against that with this product. But kids are a big part of people deciding to do this product or not do this product. So, what would you say to either clients that have children or children that are listening that are skeptical about this product for the seniors in their life? What would you tell them about this product?
So this is a touchy subject, I feel, because I do think most children, and most of the children that I talk to, They just want what's best for their parents. They really do. And so if mom and dad are struggling every month, and this will make the difference between mom and dad, or mom or dad if they're single, then most kids support that decision. I think children are concerned about having a bill left at the end. So helping them understand how the product works is certainly beneficial to that conversation. The other thing is, if mom and dad are struggling, who's helping? Most of the time it's the kids. And that may be putting a financial burden on them or their ability to help their children. Or a lot of times, I'm talking to people who have kids in college, or, so their monthly budgets are struggling as well. So this is a solution that may help everyone. Is it right for everyone? No. But is it a great solution for a lot of people? Yes, it is. And I think kids are like, well, I'll just help mom or dad. Mom or dad want their independence just like we did when we were growing up. We wanted that independence at some point. I am a certified senior advisor. And what that means is that I've gone through enormous training in older adults and all the things that impact their lives. And the number one fear that older adults have is losing their independence. And when you say to a parent, oh, we'll just take care of it, and you leave them out of that decision making, or you make them, or you feel like they're back into a corner of a decision, that can hurt them emotionally and their well-being mentally. And so I think we just need to be careful as kids. I'm an adult child. I have a mom that, we have to think through these things too when we're having conversations, that we respect them and we respect their decision making if they're still capable of making their own decisions, which most parents are.
And this next part is sort of a two-part. So what would we tell someone this part one? What would we tell someone if they say, well, that is something that I'm interested in, but I don't need the cash right now, so I'm going to wait, which leads into part two. When is the best time to really set this up? Is it
Yeah.
is it before retirement, after, when their cash flow tightens?
Yeah. So we are physically in the state of Texas, although I'm licensed in Arkansas, Oklahoma, and Kansas, as well as Texas. Texas, you have to be 62 years of age or older. And if you're married, you both have to be 62 years of age or older. And so you must be 62 in order to set this up. At least one of you must be 62 for the HECM product in all the other states, but you may have a spouse who is younger. So there's that. That's the first thing that you have to think through. This is truly a product that's simply designed for older adults, not for everyone. The second thing is you have to think about qualifying for this product. So the best time to take this loan is when you can get this loan. And so people are like, well, we don't need it yet. We're just going to wait. My concern is if something happens to one of you, what happens to your income? And while we don't qualify for this in a traditional sense, we do have some qualifiers that we have to look at. And the loss of one income in the household may impact that qualifying. So those are things that we always want clients to think through when they're thinking about when they can put this in place. The second thing is that growth of the line of credit. If you wait, you lose out on all that growth. And so the ability to have that nest egg grow to an amount that you are certain of, that now it's a variable rate, but the trajectory that it's going to take, versus waiting and hoping that interest rates haven't gone up, or hoping that your property value hasn't gone down, and not knowing with certainty what that line of credit will look like in the future. So one gives you the stability of knowing, hey, I'm starting out here, but I know it's going to grow and I know I'm going to have more funds available to me. I'm always going to say, especially in that situation where you don't necessarily need those funds right now, oh my gosh, let's put it in place and let that line of credit grow. And you'll have that security and that freedom and that sense of peace of mind of knowing where it's going to go.
So we've talked about a lot of different things: line of credit, interest rates, reasons to use it. But what's one thing you wish every homeowner 62 and older knew about this product?
It's not as scary as people make it out to be. Really am. I wish that I'm a numbers person. You know that about me. And I feel like the numbers speak. And so I always approach things from a very logical, point of view. And I wish that, I know it's your home and I know it's an emotional thing, but I wish more people would put some logic behind it, because cash is king. And cash flow is king in retirement. I think people have this built up notion of a paid off home is the goal. The goal is to have enough money to make it through retirement with a lifestyle that you want and that you can enjoy. But I think people get caught up in, I've got a paid off home. You never have a paid off home. You're always going to have taxes. You're always going to need to insure it. You know, using it, we use our 401ks, we use our IRAs. Why wouldn't we also use our home equity? Because it's something that we have built up over time, just like those other things. I wish people would look at it in their overall retirement planning, whether they decide to do this loan or not. At least they're thinking about it and they're including it in that thought process.
Makes sense. I
Yeah.
know you and I have it built into our retirement plans in the future.
Yes, we do. And I can't wait. Unfortunately, I do live in Texas. And while my husband's old enough, I'm not yet.
Me neither.
What about you, Saber? Is there anything else that you would add that you feel like you would want people to know? Because maybe you have a different perspective than I do.
My perspective's a little bit different in that usually when I'm talking to a client, it's when they've already made that decision. So when I'm talking to a client, it's usually reassuring them. I'm reminding them of the benefits. I'm reminding them of the myths versus the facts. Even sometimes when they decide that they're going to do it, they still come to me and say something. I'm like, well, no, that's not accurate. And so I try to get them right on the right path again. But no, I guess the clients that I talk to, because it's something they've already decided to do, it's just trusting the process and trusting in us that we're leading you the right direction. And this is something that we believe in for our clients and ourselves and our families. And it's a good product.
Yeah. Well, awesome. Thank you for being on today. I feel like this was a good discussion. I hope that people will have learned something from this. And if you are curious about this and you want to know more, just reach out to our team because this is something we love to talk about. My client stories are truly my favorite part of this job, and you probably heard why. Once you start talking about a HECM, it's almost impossible to stay in one lane. The line of credit is incredible, but this one can do so many things for so many different situations. If today's conversation opened your eyes a bit, make sure you subscribe to my YouTube channel for more educational videos like this. And don't miss my next podcast where we'll be diving into the Veterans Community Care Network. Thanks for listening, and I'll see you next time on Legacy Years, Finding Fun, Wisdom, and Purpose.